It is officially over. For years, this moment existed only as theory. We analyzed charts, debated leverage, and warned that one day the banks would be trapped by their own paper games. One day, the shorts would fail. Until now, that was probability. Today, it became proof. Stop speculating. The body has been found. While most investors were focused on silver surging on their screens, something far more serious was happening out of sight. Not on TV, not in headlines, but deep inside the financial system's most sensitive pressure point. In the quiet hours after Christmas, when markets were thin and attention was low, a single number appeared on a Federal Reserve report. That number was not routine. It was a confession. More than $17 billion was pulled from the Federal Reserve emergency liquidity window in one morning. This is not where strong banks go. This is the financial emergency room. You only show up when something is breaking. Ask yourself why institutions that claim to control global markets would need billions in overnight cash at dawn the day after a holiday. It was not for growth. It was not for operations. It was because a position moved violently against them and a margin call arrived that their balance sheets could not absorb. This is where theory ends and math takes over. When prices move fast enough, accounting tricks stop working. Unrealized losses become immediate demands for cash. The system does not care about narratives, it only cares about collateral. That $17 billion was not support, it was a tourniquet, a last attempt to stop a bleed before forced liquidations ripped through the market. And the timing matters. Crises are buried on Fridays because silence hides fear. This was not about silver's price. It was about solvency. And this is only the beginning. If this opening already has you thinking differently about what just happened, make sure you subscribe to the channel so you do not miss what comes next. And comment one below if you are ready for Chapter 2, where we connect this margin call directly to the silver explosion and explain why everything just changed. Now connect the timing, because markets do not move like this by accident. The same morning banks rushed to the Federal Reserve for emergency cash, silver did not drift higher. It exploded. It moved fast enough to break assumptions the system depends on. This was not coincidence. It was cause and effect. The institutions at the center of this were trapped in massive short positions built over years. Those trades only worked as long as volatility stayed low and liquidity stayed abundant. Both disappeared at once. In futures markets, losses are immediate. Every dollar move against a leveraged position increases risk in real time. And when price moves far enough, the clearing system does not negotiate, it demands cash. That demand arrived. Silver crossed internal risk thresholds that banks rely on to stay solvent. Models failed. Value at risk assumptions broke. What had been labeled temporary instantly became existential. This is where unrealized losses turn into survival problems. When the margin call hit, the banks checked their cash and found a gap. Liquidity was gone. Selling assets would worsen the situation, and buying back shorts in a rising market would accelerate the damage. So they ran to the only place left. They pledged what collateral they had and tapped the Federal Reserve emergency facility, not to profit, not to stabilize markets, but to avoid immediate liquidation. That cash was not about winning. It was about staying alive one more day. This is why the repo spike matters. It was not precautionary, it was reactive. It was the financial equivalent of grabbing oxygen as the fire spread. And here is the turning point. When institutions stop controlling price and start responding to it, the balance of power shifts. The suppressors lose control, the market takes it back. That shift marks the transition from managed markets to survival markets. And once that line is crossed, there is no easy way back. This is where most people misunderstand what just happened. They hear the word repo and assume this was routine plumbing, a temporary cash shuffle, a technical adjustment that would quietly resolve itself. That interpretation misses the signal entirely. Liquidity problems happen in healthy systems. Solvency fears appear when trust breaks. If these banks were truly sound, they would have borrowed from each other. That is how the system is designed to work. Interbank lending exists so strong, institutions never need to touch the Federal Reserve emergency window. Going straight to the Fed is not neutral. It is a public admission that peers no longer trust your balance sheet. That distinction is critical. When banks bypass the market and run directly to the central bank, it tells you two things at once. They need cash immediately and no one else is willing to lend it. That combination defines stress, not convenience, and it is how confidence evaporates. Silver's surge did not just create losses. It exposed leverage that could no longer be financed. Positions that looked manageable on paper collapsed when marked to market. Collateral values fell while obligations remained fixed, and the gap had to be filled with cash. That cash was not there. So the Fed stepped in, not as a facilitator, but as a lender of last resort. That is not stabilization. That is life support. And institutions on life support do not dictate markets. They react to them defensively and under pressure. This is why the tone of the silver market is changing. The players that once capped rallies are now constrained. Their balance sheets are damaged. Their risk tolerance is gone. Suppression requires confidence, and confidence has cracked. This was not a funding hiccup. It was a structural warning. And once markets sense a weakness at the core, they do not slow down. They accelerate. Here is the shift most people still have not fully grasped. This crisis did not stay confined to spreadsheets and terminals. It did not remain a paper problem. It crossed a line. And once that line is crossed, markets behave very differently. Paper markets fail quietly. Physical markets fail loudly. For years, banks could manage price through leverage. They sold contracts instead of metal, promises instead of ounces. As long as most participants treated silver as a trade, not as a necessity that system held. Losses could be rolled, positions could be extended, delivery could be deferred. That dynamic just changed. When prices move far enough and confidence breaks, the question shifts from what is the price to can you deliver? And that question is lethal to a paper-heavy system, because delivery is binary. You either have the metal or you don't. As silver surged, something unusual happened. Contracts weren't rolled forward. They weren't closed for cash. They were held to expiration. That behavior tells you everything. It signals that buyers no longer trust settlement promises. They want the asset, not the payout. This is where banks face a different kind of risk. Cash can be borrowed. Liquidity can be printed. But metal cannot be created on demand. When delivery pressure rises, every short position becomes a ticking clock. And clocks don't negotiate. This is why the repo bailout didn't solve the real problem. It only addressed the cash side of the equation. It did nothing to increase supply. In fact, it made the situation worse by reinforcing the fear that paper claims are unsafe. Once a market shifts from trading price to demanding delivery, the balance of power flips. Sellers lose flexibility, buyers gain leverage. Volatility increases not because of speculation, but because of scarcity. This is how suppression ends. Not with a headline, not with a declaration, but with silence from the sellers and urgency from the buyers. At that point, price is no longer a debate. It becomes a rationing mechanism. And when a strategic asset reaches that phase, history shows only one outcome. Repricing. This is the paradox at the heart of what we're witnessing. The intervention that was meant to stabilize the system is actively accelerating the forces breaking it. The $17 billion injection didn't restore confidence. It exposed fragility. Because look at the mechanics. The banks needed cash because silver was rising against the dollar. That price move signaled stress. The Federal Reserve's response was to create more dollars. But printing dollars to defend against a rising hard asset does not fix the imbalance. It amplifies it. Every new dollar injected into the system dilutes the existing ones. That dilution pushes investors further towards scarce assets, which pushes prices higher, which deepens the losses on the very short positions the bailout was meant to protect. This is a feedback loop. The higher silver goes, the more support the banks need. The more support they receive, the weaker the currency becomes. And the weaker the currency becomes, the higher silver goes. There is no exit that preserves both the banks and the purchasing power of money. This is why markets reacted the way they did. The bailout wasn't interpreted as strength. It was interpreted as surrender. It told investors that the central bank will choose currency debasement over institutional failure every single time. That knowledge changes behavior instantly. Once participants understand that losses will be socialized and money will be printed, to cover them, holding cash becomes a risk. And when cash becomes a risk, capital seeks shelter elsewhere. This is how inflationary regimes begin, not with announcements but with forced decisions. The Fed didn't choose this path willingly. It was pushed onto it by leverage, scarcity, and timing. And now the market knows the rule. If prices fall, the shortage remains. If prices rise, the Fed prints. Either way, the pressure builds. This is why the bailout wasn't the end of the story. It was the trigger that locked the system into a one-way dynamic. From this point forward, every attempt to stabilize creates more instability. Because you cannot solve a scarcity problem with a printing press. This is where the psychology of the market finally snaps. For decades, there was a reliable pattern. Whenever silver rose too fast, short sellers stepped in. They faded the move. They provided liquidity on the sell side. Price spikes were punished and rallies died young. That reflex just broke. When silver surged this time, the shorts didn't attack. They retreated, not because they wanted to, but because they had to. The math no longer worked. The risk no longer made sense. Shorting silver stopped being a trade and started looking like a suicide mission. This is what capitulation looks like. When shorts leave the market, something dangerous happens. Liquidity disappears. The sellers who used to cap rallies are gone, and prices left to float higher on even modest buying pressure. Moves become sharper. Gaps appear. Volatility explodes upward instead of oscillating. This isn't a traditional short squeeze anymore. In a classic squeeze, shorts are forced to buy back positions, creating a violent spike followed by relief. What we're seeing now is different. It's a vacuum. The shorts have already covered or stepped aside, and no one is willing to replace them. That creates a one-sided market. When price rises and no one steps in to sell, every buyer has to pay up. Every transaction happens at higher levels. This is how markets reprice, not gradually, but in jumps. The absence of shorts is not a bearish signal. It is a declaration of fear. It tells you that professional risk managers have looked at the data and decided there is no safe way to bet against this move. And once that realization spreads, it feeds on itself. New money enters. Old skeptics capitulate. Momentum replaces disbelief. What used to be suppressed becomes chased. This is the phase where narratives change. Silver stops being dismissed as a relic and starts being treated as protection. Not because of hype, but because the mechanisms that kept it contained no longer function. When control shifts from sellers to buyers, markets don't ask for permission. They move until a new equilibrium is forced. And that equilibrium is always higher than anyone expects. This is the point where stress becomes visible, not through price alone, but through behavior. In a normal futures market, most contracts never reach delivery. Traders roll them forward or settle in cash. That is how a paper system survives. But this market stopped behaving normally. As silver surged, contracts weren't being rolled. They were being held. Buyers stayed in the trade all the way to expiration, demanding the warrant. That shift is critical. It means trust in cash settlement is fading. Participants no longer want exposure. They want possession. Delivery demand changes everything. When delivery rises, shorts lose time. Each contract becomes a countdown. Cash settlements are optional. Metal is not. And unlike currency, physical supply cannot be expanded to meet urgency. This is where leverage meets reality. Vault inventories that look sufficient on reports suddenly appear thin when claims stack up. Registered metal becomes spoken for. Available supply shrinks, and once the market senses that delivery might fail, fear spreads faster than price. Because default is binary. If delivery succeeds, prices must rise to ration demand. If delivery fails, confidence in the paper market collapses. Either outcome favors the holder of the physical asset. This is why delivery data matters more than headlines. It shows intent. It reveals who is trading and who is securing supply. And right now the signal is clear. Participants are choosing metal over money. That choice marks a transition from financial stress to structural stress, from volatility to fragility. When enough players make that decision, the system cannot absorb it quietly. At that stage, markets don't unwind. They reset. At this stage, the idea that this remains a silver problem is an illusion. Markets built on leverage are never isolated. Stress travels. It moves through balance sheets, through collateral chains, through confidence itself. This is how contagion begins. Silver was the trigger, not the destination. When a systemically important player struggles to meet obligations in one market, counterparties everywhere take notice. Margin requirements rise. Credit terms tighten. Liquidity that once flowed freely starts to hesitate. And hesitation is enough. The modern financial system is a web of interconnected exposure. Positions are hedged with positions, collateralized with collateral, all layered on assumptions of stability. When one assumption fails, pressure migrates instantly. This is why central banks react so quickly. They understand that a default in one corner does not stay there. A failed delivery or forced liquidation in metals doesn't end with metals. It cascades into rates, currencies, and credit. The Fed's intervention wasn't about silver. It was about preventing that cascade, about stopping one crack from spreading into a fracture. But here is the problem. Contagion cannot be printed away. Liquidity can delay it. It cannot erase it. Every bailout shifts risk elsewhere, often into the currency itself. That trade-off is now visible. As confidence in settlement weakens, participants demand higher margins. As margins rise, leverage falls. As leverage falls, asset prices reprice. This tightening happens not because policy demands it, but because trust does. Trust does. This is the silent phase of crisis. No headlines, no panic, just subtle withdrawal. Less lending, less risk, less tolerance. And once that process starts, it feeds on itself. Because systems built on confidence cannot function when confidence becomes conditional. Silver didn't break the system. It revealed it. This is where the illusion of control finally collapses. The Federal Reserve stepped in to stop a fire, but in doing so, it locked itself into a trap with no clean exit. Every path forward now carries consequences they can't avoid. Here is the dilemma. If the Fed stops intervening, stress returns immediately. Margin calls reappear. Liquidity freezes. Institutions already weakened face liquidation. That path risks a cascading failure the system cannot absorb. But if the Fed continues intervening, the currency pays the price. Printing money to stabilize leveraged institutions does not restore confidence. It transfers risk from balance sheets into the dollar itself, and once markets understand that trade-off behavior changes permanently, this is the pivot no one announced. The Fed can no longer fight inflation and protect the system at the same time. It has chosen protection. That choice signals to global capital that real value will be defended with debasement, not discipline. And capital listens. When investors realize downside risk is capped by money creation, they stop hedging for deflation and start positioning for repricing. Cash becomes optional. Hard assets become strategic. This is not speculation. It is adaptation. That is why silver's move matters beyond its own market. It is exposing the limits of policy. It is forcing the central bank into reactive mode, and reactive policy is always behind the curve. The Fed still has tools. What it no longer has is control. Once markets sense that they don't wait, they front-run the response. They move before policy acts, and when that happens, prices stop reflecting forecasts and start reflecting fear. This is the final stage before repricing accelerates, the point where authority yields to math, where confidence yields to scarcity. And from here, the system doesn't return to normal. It transitions. This is where everything converges. Strategy replaces speculation. Reaction gives way to positioning. What began as a market event has now become a lesson in how systems behave when leverage, scarcity, and policy collide. The first lesson is simple. Systems don't break where people are looking. They break where assumptions live. For decades, the assumption was that paper markets could always be managed, that liquidity could always be injected, and that confidence could always be restored. That assumption is gone. The second lesson is more uncomfortable. There are no painless solutions left. The Federal Reserve has shown its hand. When forced to choose, it will sacrifice currency stability to preserve institutional stability. That tells you exactly where risk is being pushed. From this point forward, volatility is not a bug. It is a feature. Sharp moves, sudden gaps, violent pullbacks followed by even stronger advances. This is what repricing looks like when control mechanisms fail. Anyone expecting calm is anchored to a past that no longer exists. So what does this mean strategically? It means understanding that holding cash is no longer neutral. It means recognizing that assets tied to physical scarcity behave differently than assets tied to promises. It means preparing mentally for a world where prices move to ration demand, not to please investors. The goal now is not to predict every swing. It is to survive the transition and emerge positioned on the right side of it. That requires patience, discipline, and the ability to ignore noise designed to shake conviction. History is clear on one point: when monetary regimes shift, wealth does not disappear. It moves. It transfers from those anchored to old rules to those